Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. What has experience taught us about consequential market risk events? First, volatility in asset prices can materialize when a strongly held consensus view is shattered. Presented with new news about defaults, inflation, earnings, investors may be forced to shed exposures, right-sizing their risk allocations to this new state of the world. Market vol episodes can be especially protracted when the attendant uncertainties do not fit neatly into an Excel spreadsheet. Here, the U.S. debt ceiling checks the boxes. And against the backdrop of an emerging standoff, it was a pleasure to welcome Libby Cantrill, the head of public policy at PIMCO, to the Alpha Exchange. Our discussion explores the sometimes chaotic intersection of politics and markets and the way in which her work is utilized by risk takers at PIMCO. We spend the bulk of our conversation on the debt ceiling, and here Libby lays out how the 2023 version has important differences from the 2011 version, specifically in the degree of leverage that the Republicans had then versus now. While of the view that a default is avoided, she sees it as a last-minute agreement almost by necessity, and with that, some market disruption may occur. We finish with a discussion on where 150 million Americans are spending their time, TikTok. Libby helps frame this out in the broader context of the intensifying geostrategic rivalry between the U.S. and China, noting that tough on China has become a bipartisan view, and with the recent spy balloon incident in mind, she sees more catalysts for decoupling on the way, further tension, and the potential spillover into the market. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Libby Cantrill. My guest today on the Alpha Exchange is Libby Cantrill. She is a managing director and the head of public policy at PIMCO. Libby, it's great to have you on the podcast today.
Thanks, Dean, for having me. Happy to be here.
This is going to be a really interesting conversation at a very interesting time. Your role at PIMCO, a bond giant overseeing several $1 trillion in client assets, is really to help the firm understand this intersection between policy and finance and economics. And sometimes these matters can result in very unwelcome asset price reactions. So we'll have a lot to talk about just in terms of U.S. policy and how the U.S. is interacting with some of its rivals around the world. As we start our conversation, it would be great to learn more about you and your background. It's an interesting one. So tell us a little bit about the early part of your career and how you got into this role.
If you don't mind, I may start back when I was in high school, which is maybe a strange place to start, but I do think it's helpful because it actually informed quite a bit of my trajectory of my career. I grew up in a pretty politically engaged family. My parents were very much about their kids working in some capacity during high school in particular. And when I was looking for a job, my mom had suggested that I started volunteering for a woman who was running for the state legislature in Colorado. And that volunteer position ended up sort of a full-time internship after school. The school day was ended in high school for about 4 years. So I worked for a woman who was in the Colorado state legislature. So it already kind of had gotten my toes wet in the politics and the policy. I really enjoyed the policy making process. It was sort of democracy in action, and to a pretty wide-eyed, in some ways, Pollyannish high schooler, it was a super fascinating process and experience. I then went into college, studied economics and math and some political science, and then graduated and went to Morgan Stanley, partly because I was interested in finance. I went to Brown, so they didn't really have a traditional undergrad finance program, partly also because I needed to pay off student loans. So there's some brass tacks element about that, which I'm sure resonates with some folks. And really enjoyed my time at Morgan Stanley, but as folks probably know who maybe worked in it and that's big before, it's pretty grueling. And for 3 years, learned a lot. I was sort of the tech corporate finance division for 2 years, and then actually went into the financial sponsors and LBO group at Morgan Stanley. Again, had a great experience, but also was hoping to maybe do something different. I had an eye on business school. But then in the interim, it just happened that the woman I had interned for in the state legislature in Colorado ended up getting elected to Congress. And sort of this is a real sort of serendipity and pure luck in some ways. Just happened to have a vacancy on her staff for somebody who had an economics background. So I went down to Washington, D.C. I will tell you there was sort of a collective freak out at Morgan Stanley among the managing directors who I worked for who thought I was, killing my career and getting off track, and they wanted me to stay at the bank and what have you. So a lot of, warning about how I was making the biggest mistake of my life, not to mention I wasn't going to make any money. That part was true. I didn't make any money down in Washington, but then worked for the member of Congress from Colorado for 3 years and then had a great experience. Again, just loved being kind of in the sausage making. If it does seem like DC is run by 25-year-olds, it's oftentimes because it is. And I was one of those 25-year-olds at the time, but worked for her. She was on the Energy and Commerce Committee and was able to staff around some pretty interesting things. But again, sort of recognizing that I wasn't going to be a lifetime kind of career staffer, ended up going to business school. And so that's sort of where we are then. I was kind of at an inflection point looking for my next step, thinking about, what did I really enjoy at Morgan Stanley? I really liked the client engagement part. I liked the sort of the closeness to markets. And then on the policy part, I loved kind of the macro policy, fiscal policy, sort of the intersection of politics and markets and the economy. So I was looking for a place that would allow and kind of marry those interests together. And honestly, it sounds really cheesy, but when I stumbled upon my interview, I went to Harvard for business school. When I stumbled upon my interview at PIMCO at HBS for a summer internship, I literally thought I had found the best place to go to work. It basically checked all of these boxes. So I started at PIMCO 16 years ago. And actually, I wasn't in the policy side. I was just an institutional account manager servicing some of our really sophisticated pension clients. I really loved it. It ended up being right before the financial crisis when I joined. So was really appreciated kind of the advisor role that PIMCO was able to play with a lot of our clients during the financial crisis. But then it was also pretty clear at PIMCO that we didn't, while there was super sophisticated thinkers and macroeconomists and portfolio managers, that there wasn't really a true understanding of how Washington worked. And I think that I kind of recognized that, and then some of the senior folks at the time, Bill Gross and Mohammed El-Arian, you recognize that as well. And so that's sort of the genesis for my role today, was really out of a recognition that we just needed a few more eyes and ears in Washington, while a lot of our portfolio managers were sort of speaking to their counterparts at Treasury or the FHA or the White House. There wasn't anybody kind of tying all of that together and making sure that there was sort of one strategy and that we were sort of singing from the same song sheet, if you will. I do think it was important, though, that in thinking about this role when, almost 12 years ago, 13 years ago, that unlike other asset management firms, which do have government relations folks, of course, that's, a traditional function at a lot of financial services firms, that I also had kind of component, this read through into our investment committee. I thought that it didn't make a lot of sense if I was going to just sort of help coordinate some of our efforts in Washington for us not to be able to use that on behalf of our clients as well. So fast forward to today, and I sort of describe myself as wearing two hats. One is more in kind of policy engagement, making sure that we're talking to the right folks at Treasury and FHFA, White House, and what have you, and on the Hill. But then also, part of this is, as you said at the introduction, managing and analyzing kind of political and policy risk for our investment committee to help them make better decisions, more informed decisions on behalf of our clients.
Such an interesting role and interesting background. And as I said at the outset, it's sometimes the case that this intersection can yield very unfavorable results for asset prices. And as you mentioned, you've been in this role for 13 years. So if we go back to 2010, we're going to run into 2011 pretty quickly. And as we certainly are going to talk about the debt ceiling, the 2023 version of this negotiation, I'd love to just hear from your rendering the 2011 version, sitting in the seat that you occupy at PIMCO and the role that you play. What was that like? What were maybe some of the learning experiences from that standoff? What were some of the lessons that came out of that first big episode in 2011?
Yeah, and I would say that was probably my first kind of big test, if you will, in this new seat. In some ways, it was a proof point. It kind of underscored that there was a business case for the position that was being created. Because, of course, up until then, it was yes, policy and politics they intersect in markets. We had TARP, of course, and Dodd-Frank and what have you. But we hadn't sort of had the real threat to the safety and soundness of the U.S. credit, if you will, of the full faith and credit of the United States. So that in some ways was an episode, again, that was a bit of a test. That was when Bill Gross was here at PIMCO and Mohammed and actually Rich Clarida, who ended up going to the Fed to become the vice chair and then has actually recently rejoined, which has been wonderful. So he and I were sort of in the hot seat during that entire episode. So starting in the summer of 2011, folks may not remember, there was sort of this dance between President Obama, very unlike today, right, where President Biden has really staked out this, we'll talk about this position of not negotiating. President Obama was willing to negotiate. And if you would remember, Dean, he had actually created the Simpson-Bowles Commission earlier that year that was really kind of charged with trying to find waste in government spending and ways that we could cut back on entitlement spending and what have you and get our sort of fiscal house in order, so to speak. So Obama was really willing to negotiate. And Speaker Boehner, of course, wanted to come to a deal. But during kind of those weeks of July and then August, and I was actually pregnant with my first child, so I remember this very vividly for a variety of reasons. I was also worried that I may actually deliver my child in the investment committee in front of Bill Gross. So there was that concern as well. But it was also clear to me that there wasn't going to be a deal. And so that was sort of the first time where, this political intelligence, if you will, I think did come in handy in terms of our positioning. Bill Gross had a concern that there was real debt level issue and that, a lot of investors would just avoid treasuries kind of regardless of what would happen if there was a resolution or wasn't a resolution, if we went through a technical default. That was, of course, the time where he took his treasury position nearly to zero in his total return fund, if you remember that. It was a really interesting, fascinating period, but also I think one where I sort of saw the value in having kind of eyes and ears on the ground in Washington and be able to sort of understand which questions to ask of folks on the Hill and then, which information would be key. I do think part of my job is really to be a translator, if you will. There's so much noise in Washington, and I try to cut through a lot of that on behalf ultimately of our clients, but also, indirectly to our investment committee.
Yeah, I just remember that episode so well. My wife was pregnant with our third during the financial crisis, but not afterwards. That debt ceiling was really formative for me personally in just assessing market risk. I spent a lot of time thinking about tail outcomes. If you're in derivatives, you're always thinking about where is the next shock going to occur. And boy, that uncertainty imposed itself on markets in a way that we just don't see very often. It's just, you don't see the VIX go from, I want to say by late July of 2011, it was around 15 and it got very quickly to 45 in a matter of 2 weeks or so. It's just rare that you see something that moves that quickly. You can certainly put the GFC in there. You can put COVID in there. So it ranks among the fastest rises in the level of uncertainty. I'm remembering the book that Bob Woodward wrote. It's called The Price of Politics. And he did a very exhaustive reporting on the debt ceiling. And one of the takeaways for me, in addition to how dysfunctional our politics can be, or maybe this is the takeaway, is that at some point, I think both sides really said, okay, enough's enough. This stuff's getting scary. These market prices are moving. The threat of the downgrade was certainly there. I'm not sure if it had materialized yet, but all parties wanted to have something locked in to create the space in terms of the debt ceiling. But at some point, they almost lost the ability to actually get there. It was almost like there was not the right kind of consensus on both sides, even though the leadership wanted it to occur. So I thought that was fascinating. Inside PIMCO, I'm just curious, just in terms of the way in which you and your thought process would interact with folks that were overseeing the capital. Take us a little bit through that if you can, just in terms of the discussions around the risks. You and I talked about this on an earlier call where paradoxically the bond market rallied ferociously during that period. So that's always interesting.
Yeah. And that's, of course, because there was the European debt crisis going on as well. So I think that people kind of forget that, right? That there were other things in the macro economy And that's, I think, also the time that led Bill Gross to sort of say that U.S. Treasuries were the cleanest dirty shirt. So even though our debt dynamics didn't look great then, of course, they look much worse now, but that there's still something about having the reserve currency and property rights and all of the things that we have in this country that may not be found elsewhere. So that's when he sort of deemed Treasuries the kind of the cleanest dirty shirt, realizing that his vast underweight to Treasuries was not necessarily a great idea, and he wrote a mea culpa and what have you. I mean, in terms of sort of the communication with our investment committee, but then also I would say broadly with our trade floor. And some of my job is to be input into the real macro. So what does the fiscal trajectory look like over the next year? Who may be in office in a year's time, and what is that? What are implications for both fiscal policy and other and regulation, and how does that translate into sort of appetite for risk markets and stuff? But then also part of my job is more kind of micro, right? So we may own an EV battery company. So my views on the Inflation Reduction Act and the Build Back Better bill were kind of instrumental into some of those positions. So there's kind of the macro and then the micro. So a lot of times I'm communicating kind of with different groups of the trade floor, depending on what's happening. We are very much, for better or for worse, still very much an email culture here at PIMCO. There are these stories which are very much true. It's gotten a little bit better, but the trade floor is very quiet at PIMCO. It is not like people are not throwing footballs or yelling at each other or what have you, like you might find on the sell side. It is still a very quiet trade floor. So we are more of an email culture. So there's a lot of kind of email traffic back and forth. But then there's also whether I present directly to the investment committee. We have regional portfolio committees. I sit on our America's Portfolio Committee and then input into that, and we have weekly meetings and what have you. So lots of kind of different avenues in terms of communicating with the capital allocators, as you said. But again, some of it's more macro and targeted towards the whole trade floor, and then other times it's more kind of idiosyncratic position that we may own. So I might just be dealing with one portfolio manager or one credit research analyst or what have you.
Well, you mentioned email culture and putting together your analysis, and at least what I have been able to read has been really informative. You do an incredible job of taking this vast universe of information and finding a way to distill what's important and why. And I'm sure that's a skill set that's been honed over many years. But I would be curious to ask you, in terms of your process, if there is a way of describing it, just in terms of keeping an eye on all of these things at once, and then having that kind of internal meter to say, well, hey, this is important, or the market doesn't understand this fully. Walk us through that, just in terms of how you're able to see what is important and what might not necessarily be reflected in some asset price that PIMCO cares about.
Yeah, and I do think that can be a challenge, especially kind of depending on what's happening in Washington, D.C. And I appreciate your compliment. The note you're referring to as a weekly client note. And if anyone is listening and they're a client of PIMCO, we're very happy to put them on the distribution. But I do think that is something that has been kind of honed, and I've gotten better at it. I think, again, going back to that 2011 time period, Bill Gross was pretty matter of fact and direct when he communicated with folks. And one time he sent me an email and he said, we don't trade GDP futures, which is totally fair, meaning that kind of some of this really macro stuff might be interesting to people. Maybe it matters like incrementally, but unless it can really have a direct impact on the economy, again, on whether it's fiscal or from a regulatory perspective or one of our specific positions, then we may not care about it. And I like policy. I like all that. I'm kind of a policy nerd. So I do have to sort of sometimes catch myself, like, is this really relevant? Can folks actually, is this going to make them understand the economy better, understand sort of the political dynamics of this particular issue better? Does this have a bottom line to it? And there's sometimes where I think something's really interesting, but I'm like, not sure that actually does matter. Now, there'll be other times, kind of conversely, where I may kind of use that filter and may filter something that I just don't think will be relevant. And it turns out that actually people do care about it. So it is a little bit of an iterative process as well. But when I'm thinking about that Monday note that I write to clients, I just think, okay, what are like the most important things that move kind of the markets or the economy that's happened over this week or the upcoming week? But again, really with that, trying to have that real clear-eyed discipline around, does this actually matter to the markets, or is this just kind of interesting because I'm a policy nerd or what have you? So I think always kind of checking myself and really always iterating, and then also asking for feedback, which for better or for worse, PIMCO is great at giving. I feel like I've honed that also over the 13 years that I've been doing this job.
Well, we talked about 2011. You mentioned the GFC in 2008. And I want to say one of Bill Gross's quotes that came out of that was shake hands with the government and buy what they're buying. Of course, that didn't turn out to work for Silicon Valley Bank, but that's a different story. As before we talk about the here and now, kind of items on your docket for analysis, one question just around 2008, which is just an instance where the market misunderstood policy or misunderstood the implications of a policy change. Can you just go back and think through, maybe over the last decade where you saw something or your work, led you to something where, hey, wow, the market really doesn't get this, whether it was around a government shutdown or something where the left and right were arguing policy-wise, where there were implications that weren't really properly understood?
I think that I think people sometimes overstate the importance of elections, particularly the presidential election, and they sort of underestimate the importance of Congress. So one thing whenever I'm talking to clients when we have a presidential election cycle, again, that's the presidential, there's a good reason to be focused on it. They're the leader of the free world and the commander in chief and all of that. But in terms of like the things that the market really cares about, oftentimes Congress actually has to approve that. And so while focusing on the composition of Congress is much less sexy and people's eyes roll or they go to sleep when I'm talking about it, it actually ultimately can be just as important, if not more important. And I think one area that there's always kind of tension, even within the walls of PIMCO, about when we have a new president and they sort of think that like the president is the king and they're going to be able to rewrite all of the regulation and they're going to be able to pass all of the fiscal, whatever they want to do. That just typically is not the right way to think about it. So I think oftentimes I'm sort of pulling back the expectations, whether Joe Biden, who's going to pass $15 trillion of stimulus. If you remember, some of his plans were scored at like $10 trillion. And I kept saying with a 50-50 Senate, there's no way that will ever be approved. Now, some people don't like that. I mean, that's sort of bringing people down to earth. And I always feel like I'm like the Debbie Downer both ways. When President Trump was elected, it was like he was going to deregulate everything. And I kept saying, well, actually, Congress is the one that has to give him the authority to do that. He only can move the needle incrementally. So again, I think there's sort of this reflexive instinct to sort of, again, overstate the importance of some of these elections, especially the presidential, and kind of undervalue what's actually happening in terms of the people who are really, writing the laws. I feel like I always state that the first year after an election, I feel like I'm educating everybody about just like basic civics too, about, who actually has the authority and what they have the authority to do. Now, of course, I will just say, to be fair to those people, both presidents, both President Biden and President Trump have tried, and President Obama and President Bush before him have tried to kind of push what the executive can do without Congress. Now, we've seen the courts actually kind of bat that back. We're probably going to see that with the student loan ruling, for instance, with President Biden trying to cancel student loan debt, something I never thought he could do unilaterally. And I think the courts will probably agree with that. But so to be fair, presidents have tried to, there's been sort of some kind of power creep in terms of what they've tried to do in terms of their authorities. But again, there really are, the Constitution's pretty clear about what the president can and cannot do and what Congress is empowered to do and not do.
Yeah, I think it's because these days, the partisan divide being what it is, the candidate from the left and the candidate from the right, the way in which they present themselves has literally no overlap at all. It's almost as if they're from different planets. There's that just polarization in our politics. But one thing that the left and the right do seem to have in common is debt, is running up a just extraordinary amount of debt. And you mentioned the Simpson-Bowles plan. I had actually Alan Simpson speak at one of my firm's events back in 2012. And one of my favorite lines that he said is, the problem is no one knows what a trillion is, that a trillion is a truckload of money. And I want to say by 2020, Simpson-Bowles had the U.S. debt to be around 20 trillion. And here we are north of 30. Now, we did have COVID and that was an emergency, but the dynamics are pretty awful. It's really difficult to say that's a partisan statement. And so, Libby, here we are with another debt ceiling negotiation in the offing. And you sent out that video of McCarthy talking at the NYSE. And he sounds totally reasonable about wanting to at least have some engagement, except for the fact that the Republicans have really done the same thing as the Democrats. So frame out for us the 2023 version of the debt ceiling. I know you've said a number of things about it potentially not being as significant, but something we should keep an eye on as well. Give us the framing of this debate.
Yeah, so I think all of that is right. If you ask members of Congress, certainly on the Republican side, but also on the Democratic side, maybe more privately, if folks will absolutely concede that we are not on a sustainable trajectory. Of course, there are some pretty real implications of that. The Social Security Trust Fund is estimated to run out in a little bit more than a decade. The Medicare Trust Fund is likely to be impaired in sort of the same time frame. So there could be some real substantive policy consequences that we can't actually honor those obligations to folks, but also then political consequences, of course, because older people also vote. And so if they can't get their benefits, that becomes a real problem. And that has been, Glenn, that's been sort of the problem, honestly. That's also been sort of the problem, honestly, just with this debate over the last decade, is that the folks, in order to really move the needle in terms of the fiscal trajectory, it really will entail a real evaluation of our Social Security and our Medicare programs. Now, Social Security, I think, is actually easier to fix. When I was on the Hill 20 years ago, there were lots of levers that you could pull, means testing or changing the inflation index in terms of the way that benefits are indexed and then paid out, obviously increasing the payroll tax and covering more of the wealthy folks. It's a pretty easy fix. It's just a question of political appetite. And I think what folks have said over the last decade, I'm really on both sides of the aisle. Interestingly, it used to be just the Democrats, but now the Republicans with sort of President Trump as well have said, we're not going to touch those. Those are sort of the third rail in politics. And even if that's really the thing that we really need to tackle, because of course it's 2/3 of the budget every year goes to entitlement spending. So we're really talking about, when we're talking about discretionary spending, it's just such a small portion of the budget. You really, again, to move the needle, you need to tackle entitlements, and yet the political appetite on both sides of the aisle is not there. So we kind of fast forward to what Speaker McCarthy has put on the table, that in exchange for a year's debt limit increase, that the discretionary spending on the non-defense side, so not even the defense side, the non-defense side, and peel out veterans benefits would go back to the 2022 levels and then grow at a slower rate. And then he had a couple of other things, including the student loan cancellation, that would also be overturned and reversed. The problem is a couple of things. One is that really doesn't move the needle on the fiscal trajectory. So regardless if you are a Republican or a Democrat, love him or hate him, it really just practically it shaves off about $1 trillion of the deficit over 10 years. So, it helps, but it doesn't really help. But the other issue, of course, is that attaching it to the debt ceiling. And the debt ceiling, it is no wonder that Republicans are trying to use it to get concessions. It really is the only source of leverage that a party out of the White House, out of power, has. No wonder that they are using it. It's not a surprise at all. But of course, the debt ceiling is really simply to honor spending that we've already made. You're simply paying off a credit card, if you will, after a big bender. So if we really want to talk about future spending, we should talk about it when we're actually determining future spending. And there will be an opportunity for that. That will be in September when Congress has to pass a government funding bill for the following fiscal year, which starts on October 1st. But I think, again, not making a partisan statement here, right or left, trying to attach this to the debt ceiling, it's just kind of a fool's errand. And Ronald Reagan has talked about a clean debt ceiling increase. And of course, so have Democratic presidents and what have you. So I think that is sort of the problem. It's not necessarily that Speaker McCarthy hasn't put together a fine plan. Again, I think that the argument is that it just is too incremental to really change the trajectory, but it's kind of what vehicle he's attaching this to, and that's where President Biden is. So that's sort of the stance that he's taken. Unlike President Obama, again, who was willing to negotiate over the debt ceiling, I think President Biden, probably having learned the lesson from that episode, has said, absolutely not, I will not negotiate. But if you want to talk about spending cuts, let's talk about them in the fall when we actually are talking about future spending and not simply paying off the spending that we've already obligated. It's already kind of out the door, if you will. I will just say lastly, I do think that the politics around this are very different from 2011. And so, my view, and not to be sanguine about this at all, because of course we do own a lot of Treasury debt and we have to take this seriously. But I just don't think, unlike 2011, where the politics really supported at that time Speaker Boehner kind of taking us to the brink and trying to make the case for spending cuts in exchange for a debt ceiling increase, politics just don't support that. 2011 was on the heels of the Tea Party coming into power when they were basically singularly charged with cutting spending. President Obama, again, was willing to negotiate over the debt ceiling. That's something President Biden is not. And Republicans had a much bigger majority in the House than they do now. Right now, they can only lose 4 votes and still pass a bill. So they just McCarthy doesn't have much cushion. And interestingly, I'll then stop talking about this, but McCarthy is having a hard time selling that deal that he had put forth earlier this week to his caucus. Some Republicans don't want to increase the debt ceiling at all. And other moderate Republicans say, why am I going to vote for a debt ceiling bill that's just going to fail in the Senate? So I think the bottom line here is we'll see where McCarthy's plan goes. But at best, it gets through the House and then just dies in the Senate. But I do think all of this sort of argues for what will probably happen is that the debt ceiling will be increased. Maybe President Biden gives somewhat of a fig leaf to Republicans. Maybe they create a commission to look at spending. Maybe they get energy permitting reform through. And I think President Biden's no dummy. He knows that he has to give some kind of political cover to McCarthy here in order to get something done. But I don't think it's going to be spending cuts. Even if we do see spending cuts, I don't think they're going to be material at all. So I kind of say to clients, we've seen this movie before. We know how it ends. There will be brinksmanship. There probably will be some volatility in the market, maybe a good thing for active managers like us. But I think at the end of the day, this will be resolved because, again, the political incentives just do not support defaulting. It is just the polling on this, the political climate is just very different from 2011. And as such, I think there will be a resolution, but probably not until the last moment.
Yeah, that's a great framing of the differences. And it just, as you emphasize, the leverage that seemed to come out of those 2010 midterms was substantial. The shellacking that the left took, in the words of Obama, and the Tea Party was very engaged and felt they had a mission. So it does feel different. I think McCarthy just wants to get some response, try to save a little bit of face. And you did mention market prices. So one of the things that is making the rounds a little bit, and I don't put a ton of stock in this market price because it's a trade by appointment, but the sovereign CDS level on the United States. So here's an existential type of asset. That spread is the highest since right around 2013. I know we had a little mini episode in 2013. We had the fiscal cliff as well, but that's up a ton. So I don't know that you make too much of it, but at least by one market metric, there's some fear that's being expressed in prices.
Yeah, and I think you're going to start seeing market participants, whenever we find out the X date, that's the other complicating factor, of course, here is that in other previous debt ceiling debates or what have you, we usually had a little bit more clarity around the X date because this is sort of falling right after these tax filing dates. Of course, today was one, and then June 15th is the other important inflection point. It is possible that the Treasury is not able to get past June 15th, meaning the X date falls before that. So depending on kind of where receipts come in, I think there's some news today that actually receipts might be lower, and as a result, the X date may be earlier. So that is kind of one kind of complicating factor as well, is that we actually don't know exactly when the X date is. I mean, you're right about CDS. Of course, we probably would. I mean, that's such an illiquid market, and to your point, kind of trades by appointment and what have you. So it's a very specific of, folks who are trading that. But what you're seeing in terms of the T-bills market and, of course, then equities, if folks aren't really paying attention, I think you'll start seeing folks, once we get the X date clarity, people will probably try to avoid that date to the extent possible in terms of having maturities lining up right around there. But, outside of that, you're not seeing much. Now, one thing, though, is that, of course, this is affecting the mechanics of the way the Treasury manages their debt and their debt issuance. So you are sort of seeing a pullback of bills issuance in favor of longer-term debt. And that's kind of interesting because that means that there's sort of a scarcity in bills. And so instead of that kind of is the opposite effect, if you will, in terms of rates going up. So this definitely will have some kind of market impact. But I think for now, the market's relatively sanguine, except for, as you said, the CDS market maybe.
Well, as you just mentioned, the T-bill market, and I think the Treasury just issued something on the order of $55 billion of 3-month bills at 5.1%, which is just kind of opens your eyes. It's a real number. Of course, the Fed tightening cycle is how that Treasury bill yield got to that level. And then caught up in this Fed tightening cycle is the collapse of Silicon Valley Bank, Signature Bank. And so there's been a very mini banking crisis. It's something that, as you wrote, required this systemic risk clause to be invoked in trying to kind of bring this thing to a stopping point, lest a full-blown deposit run occurred. Walk us through the politics of the aftermath of SVB and how you see things materializing from here.
That was sort of an interesting, fascinating 48 hours. This is a little bit, again, we're kind of a disconnect between maybe what the markets and economists were seeing and what the Hill was seeing. But on Friday morning, I had reached out to some Hill staff on financial services and Senate banking and just asked them, are you concerned about this? At that point, SVB, of course, had been taken into receivership, or maybe it was right before they were about to get taken into receivership. And they're like, no, this is not really something we're worried about. This is really idiosyncratic. This has just to do with a bunch of rich tech depositors and this kind of weird network effect via Twitter. And it's super specific to this area. And so, no, we're not worried about it. And when staffer on Ways and Means said, look, Janet Yellen was in front of our committee this morning and no member, or maybe one member, asked her about SVB. So that was Friday, right? That was March 10th, if you will. And then, of course, things changed really quickly. And then by the time I was talking to staff on the 11th, then they're like, oh, wow, we're actually really worried about this. This feels much more like it could be systemic, and maybe we'll wake up on Monday morning and there could be a run on every regional bank. And I think that was more aligned with our view as well, that if policymakers hadn't done something, and of course, I think the priority really was to sell SVB. Policymakers were really trying to focus on that. But short of being able to do that, then I think there was sort of this recognition that they needed to do some other things. I don't think it was very straightforward for some of the folks who had to vote for that, especially at the FDIC, but they did end up moving forward in a way that in some ways they had to, because I think short of course, selling SVB over the weekend, I think they realized that Monday morning, if they didn't do something, that markets would have reacted very negatively, and that every small business, uninsured depositor at every regional bank might be inclined to then pull their money. So I think there was real concerns about sort of the systemic effects. So as you said, FDIC voted for the systemic risk exception, something they'd only done, I think, 3 other times in history, which then allowed for them to provide a guarantee for all these uninsured deposits on Signature and SVB. And then, of course, the Treasury and the Fed moved forward with 13.3 facility, which they've become very familiar with. This is liquidity facility that they used during COVID and, of course, during the financial crisis as well. Now, after it, though, and this is, again, maybe to your question about when there's sort of a disconnect, I think then folks kind of in the investment world were like, well, of course, Congress is going to raise the FDIC insurance level, or Treasury is going to somehow use some magical power, even though they don't really have jurisdiction to do this, to provide a guarantee for all uninsured depositors. And I kind of was like, nope, they're not going to do that. First of all, I don't think the Treasury could do that, doesn't have the authority to do that. But then more importantly, Congress, who does have the sort of statutory authority, because that's a statutory level, that $250,000 threshold FDIC insurance guarantee, the Congress did not have the appetite to do that. And that was really reaffirmed at those hearings that the days after this, where members of Congress really wanted to look at the Fed. The Fed needed to do more. There was, obviously some lapse in supervision, but also the Fed has some tools in order to increase capital and liquidity requirements for the regional banks, but the Congress was really not interested in legislating on this. So that was kind of my early call right after all of this, and I think that's sort of proven out. The Congress really wants us to be in the rearview mirror, and again, they think, rightly or wrongly, that the Fed already has these tools. I would argue that they mostly do. They do have quite a lot of discretion about how they impose some of these capital and liquidity requirements still on the regional banks. So I do think we're going to sort of see more regulation of these banks over the next year or so. And of course, that could have the consequence of ratcheting back on credit in the economy at a time where the economy is already slowing. So that could be just another headwind, but I think the Fed will take that trade all day long. Of course, it does also do some of the heavy lifting in terms of getting inflation out of, under control, and maybe it makes them not have to raise rates as much as they would have otherwise. So I'm not sure the Fed's going to think that's a bad idea or think that's a bad kind of a trajectory to go down, but I think that it's very clear that Congress does not want to do anything. And as a result, I don't think we should expect to see this FDIC insurance level increase anytime soon.
It's a really interesting setup, and you make the point around the speed with which deposit flight occurs. If it's happening slowly, well, the potential financial stability risks are probably lower, even though it might be long-term pretty detrimental to the business model of a regional bank. So I think that's probably the Fed's chief concerns. One thing that's just happened today, I'm not sure if you had seen Apple's foray into banking. So they've got a high yield savings account with an interest rate of 4.15%, working with Goldman Sachs. They say it's 10 times the national average, and you can fund it up to $250K with probably 3 swipes, right? So, I mean, the fintech part of this, I think, as well, is very interesting. You can move money around much more quickly than you used to. And I think that was part of that run on SVB, is the way in which financial technology has enabled you to very quickly mobilize your own capital. And it just seems that this capital is going to wind up in whether it's an Apple account or something that's just the highest bidder. And I think that just is going to be a big headwind for some of these banks that rely on very low cost deposits.
Yeah, I think that's absolutely right. I mean, we've been pretty careful in terms of just communicating to our clients that, we don't think all the regional banks are a monolith. So to kind of say this is like a systemic crisis across all regional banks, we think is sort of a misnomer. But to your point, I mean, there are some real headwinds for both regional banks and then other banking institutions. Sort of to your point, there's this innovation and these really low barriers to entry. I mean, you used to have to stand in line when there was a bank run. So that was just, the effort of exercising that was in some ways a barrier. But now you don't. You can set up an account at another bank and basically instantaneously transfer your assets over. So I think all of those things are going to be on the table for policymakers to think about. But as we know, policymakers are also oftentimes fighting the last war and not necessarily kind of seeing what's coming down the pike. No fault of their own, right? I mean, they just are, it's kind of human nature, right, to think you're sort of fixing the last problem and not necessarily looking forward to the next. But I do think that this will force policymakers to really kind of reevaluate, does the sort of banking regulation paradigm make sense for today's world, again, with these low barriers to entry and low switching costs, if you will, that exist today.
Well, everyone's using their smartphone for banking, but they're also using it to spend some time on TikTok. I wanted to get your thoughts and how you're looking at this area of concern, I think, at a geopolitical level, and perhaps some version of bipartisanship, which is this view that TikTok is on the dangerous side, given the confrontation we're having at a strategic level with China. Tell us about that, just in terms of what you see, where you see that going, and what the maybe legislative implications might be with TikTok.
TikTok maybe is a symptom, but there's a bigger issue, bigger problem. To your earlier question about maybe when there was a misunderstanding between the market and Washington, I mean, I think the market and market participants kind of misunderstood the longevity of what President Trump was doing on China. I think people sort of thought, and maybe President Trump may have just had transactional aspirations with China. I mean, I think he obviously wanted to get something from China. He felt like they had been taking a lot and maybe not honoring their promises. But what I kept sort of saying to folks internally, that there's a whole other sentiment behind that in Washington of folks who've been there for a long time and will likely outlast President Trump. And a lot of them are in Congress. And actually, you look at Chuck Schumer, who is the majority leader of the Democratic side in the Senate, of course, and then former Speaker Pelosi in the House. And both of them are kind of the original China hawks, if you will. When I was on the Hill 20 years ago, they were both the most outspoken, and it was for different reasons, both of them. I mean, Schumer was worried about currency manipulation, and even then kind of being taken advantage of economically. Pelosi was very focused on human rights and Taiwan, even back then. But it's just kind of interesting that those folks who then, of course, ascended to leadership were at that point 20 years ago when China was being considered for ascension to the WTO, that they were already a lot of skepticism. And so when President Trump, in some ways, was sort of the tip of the spear of that, and when he kind of felt like kind of opened Pandora's box, just knowing that sort of skepticism around China on the Democratic side, but then also on the Republican side, I think a lot of Republicans joined Democrats and they were concerned about national security issues and other economic and trade issues, that folks kind of thought that, like, well, once President Trump gets out of office, President Biden will come in and things will kind of revert back to normal with China. And again, that was one area where I was sort of cautioning that folks were being kind of too Pollyannish, that there was a lot of the skepticism. And then, of course, you brought up the point that this is very bipartisan, and it's also bipartisan in terms of the electorate. So if you just look at the polling, better or for worse, there's a lot of skepticism, if not antipathy, for the Chinese Communist Party among the U.S. electorate. Now, some of this, unfortunately, I do think is fueled by, maybe xenophobia, maybe even racism in some cases. But it is what it is. Whatever is motivating it, folks are upset with China. And then I think President Xi, of course, has sort of exacerbated that because, he arguably is more authoritarian and he has grander ambitions, certainly than Hu Jintao did, who was his predecessor. That's all a little bit of a toxic soup, if you will, because I think that it all means that there really will be many more catalysts for, I won't say decoupling, because we're, of course, so entrenched with China economically, but more catalysts for increased tension with China that could actually have market implications than catalysts for reconciliation. And of course, what you see, this is like the spy balloon issue. Like, accidents are much more likely to happen, and then kind of overreactions to accidents are much more likely when you have these sort of simmering, if not low boil tension. So just want to kind of set the scene, because I think this is like TikTok, again, is one example of that, or one output of that. But this is a much broader issue in Washington and is bipartisan, and importantly, will, I think, continue to, get worse regardless of who's in the White House in 2025. And I think, again, it was sort of a misnomer by the markets to think, Pollyannish to think, that there would be a sort of a switch of tactics or what have you when Biden got in, because, again, I think folks were underestimating or not seeing this decades-long skepticism that had existed before Trump kind of opened Pandora's box, if you will. So on TikTok, if this special committee, so there was a select committee in the House that was formed on a bipartisan basis. They don't have legislative authority, but they do have subpoena authority, and TikTok is one of those things that they are looking at. There are several bills right now they're trying to be a facilitator for. I think the threshold to pass something in a split Congress is quite high. But again, there is a lot of shared sentiment and concern about TikTok. I do think, though, on China, Dean, the real action is going to be at the administrative level. And we've already seen some of it, and it's a little bit pernicious, but I do think it kind of amounts to quite a lot on the substance side. I think in some ways, Trump was rhetorically very strong against China, but from a policy perspective, of course, he imposed the tariffs. But I think that while the Biden administration maybe is rhetorically a little softer on China, I think substantively they're actually maybe even more punitive than what we saw under President Trump. And what I mean by that is we've seen these export controls on semiconductors that started in October. That was very targeted on advanced leading-edge semiconductors. But something that was very interesting about that, it was basically a prohibition against the United States exporting any of that technology. But then importantly and very interestingly, it was also a prohibition on personnel. So if you're a U.S. citizen, for instance, working in China for, say, a semiconductor company, or on something component that may be used for a semiconductor company, you basically have to pick your job or your citizenship for the United States. That was how kind of draconian this executive order was. And I do think that is an indication of kind of what the sentiment is in Washington. And while that was very surgically focused, that we think that's just the beginning, that there will likely be more export controls around other industries. And then importantly, and this is something we really haven't seen in this free capital society, is there probably going to be capital flow restrictions going towards China, that we are waiting for an executive order from the Biden administration. Again, we think it will be very targeted, semiconductors, AI, quantum computing, maybe biotech. And it will likely be more of a screen or disclosure framework than it will be just an outright prohibition. But I do think there could be, in some cases, depending on where capital flows are going and kind of where companies, that there could be an actual the U.S. government saying, no dice on that. We are not going to let that investment go through. So long way of saying, there's, I think, some action on the Hill, though I think the bar is quite high to pass anything in a split Congress. But I really think that there will be quite a bit of significant action, again, continued at the administrative level. And again, I don't think that's going to change kind of regardless of what happens, in 2024, who sits in the White House in 2025. I think the direction of travel is unfortunately quite negative with China.
Well, Libby, you've given us a lot to think about at a especially fraught time, both internally with our dysfunction here in the U.S., but also externally with rivals like China and Russia. So given us a ton here. Thank you very much for being a guest on the podcast. It's been great to learn more about your process and your work. Thank you, Libby.
Thanks so much, Dean. Appreciate it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.